So today I want to slow things down for a moment and talk with you about something that's been quietly sitting in the background of a lot of financial news lately. The Federal Reserve has decided not to cut interest rates right now. They're holding them where they are. And on the surface, that can sound boring, almost like nothing happened. But in practice, these nothing happened moments are usually the ones that affect everyday life the most. Because when rates stop moving, whatever pressure you've been feeling tends to stick around a little longer. Now, before we go any further, let me ask you something. And there's no right or wrong answer here. When you hear news about interest rates, do you usually feel relieved or do you feel uneasy? A lot of people tell me it's a mix of both. So here's what actually happened. After cutting rates several times over the past year, the Fed decided to pause. Their main rate is sitting in the mid 3% range, and for now, they're choosing to wait. When the Fed chair spoke about it, he described the economy as stable. That means people are still working, spending hasn't collapsed, and there's no emergency forcing their hand. But, and this part matters, inflation hasn't fully gone away. Prices aren't rising as fast as they were a couple of years ago, but they're still rising faster than the Fed would like. So the Fed is basically standing in the middle. On one side, jobs look okay. On the other side, prices are still uncomfortable. And when they're stuck between those two, they tend to slow down and watch instead of making bold moves. Now, markets react instantly to this kind of news, but households don't. You don't feel a rate pause in a headline. You feel it slowly through bank statements, loan payments, and decisions you keep putting off. Let's start with savings, because this is one area where higher rates have actually helped people. If your money is sitting in a basic checking account, earning next to nothing, this pause quietly works in your favor. High-yield savings accounts are still paying rates that would have sounded impossible just a few years ago. That doesn't mean they'll stay that way forever. But right now, the pause means banks aren't rushing to lower those rates. And I want to be clear about something. This isn't about beating inflation perfectly. It's about not leaving money on the table. Earning something is still better than earning almost nothing. For people who like more structure, certificates of deposit are also worth mentioning, especially the newer ones that don't penalise you if you need your money early. They're not exciting. They won't make headlines. But they offer something a lot of people value right now: predictability. And that same idea carries over to short-term US Treasuries. They're paying solid yields, and for many people, the tax treatment makes a real difference. The pause gives you time. You don't have to rush into anything. You can actually compare options instead of reacting to another rate change every few weeks. Now let's talk about the other side of the picture, debt, because this is where the pause can feel heavy. Even though rates have come down from their highest point, borrowing is still expensive. Credit card rates are still painfully high. So if you're carrying balances, this pause is the Fed quietly saying, relief is not arriving quickly. And I know how discouraging that can feel. Making payments and watching balances move slowly can drain your energy. But here's the honest truth. Paying down high-interest debt is still one of the most powerful financial moves available right now. Not flashy, just effective. And that's the environment we're in at the moment. Stable, but not easy. Calmer, but still demanding attention. Let's talk about what that means going forward. One area people keep asking about is housing. Mortgage rates have come down from their peak, but they're still not low by historical standards. For some homeowners, refinancing just doesn't make sense yet. And that's okay. You don't have to act just because rates moved a little. Sometimes the smartest decision is waiting and focusing on what you can control in the meantime. Extra principal payments, a stronger emergency fund, less financial stress. Auto loans tell a similar story. Car prices are still high, monthly payments are still heavy, and rates haven't fallen enough to suddenly make new cars affordable for everyone. So if you're holding off, you're not falling behind, you're being cautious. And in this kind of environment, caution is not weakness, it's discipline. Now, there's also a political layer to all of this, and it's worth touching on briefly. Some political voices, including former President Trump, have pushed for lower rates to support growth and housing. Others worry that cutting too fast could push inflation back up or weaken trust in the Fed. Wherever you stand on that debate, the outcome right now is simple. The Fed chose to pause. Historically, pauses like this are crossroads. Sometimes they lead to more cuts later. Other times they lead to a longer stretch of steady rates. Markets are currently expecting maybe a couple more cuts down the road, not a dramatic shift. That's why planning as if rates will stay roughly where they are is often the most realistic approach. And this brings us to the most important part of the conversation: what this means for you day to day. It means leaning into what actually works right now. It means reviewing where your savings sit instead of ignoring it. It means being honest about debt and focusing on the most expensive balances first. It also means resisting pressure to buy, pressure to refinance, pressure to do something just because headlines changed. Here's something people don't talk about enough. Emotionally, a pause can be a gift. When rates are moving fast, it feels like you're always late, like you missed the best moment. A pause gives you breathing room. It gives you time to make decisions without panic. You don't need to predict the Fed perfectly. You just need a plan that works, even if nothing changes for a while. I've seen this play out again and again. The people who improve their finances the most aren't the ones who time things perfectly. They're the ones who stay consistent while everyone else overreacts. Small improvements, better habits, less stress. So as we move through this year, remember this: a pause doesn't mean your life is on hold. It means adjusting to reality as it is right now. Rates are higher than they used to be, lower than the peak, and stable for the moment. That stability can be used. You can earn something on your cash. You can make progress on debt. You can slow down big decisions and think clearly. And honestly, that calm mindset might be the biggest advantage of all. So keep asking questions, keep learning, and keep making steady, thoughtful moves. That's how you get through moments like this, not by rushing, not by worrying, but by staying grounded while the noise keeps spinning.